Hey everyone, and welcome back to another video. For today. We are in the month of September, and as you know, September is historically a bad month for the stock market, which usually means it's historically a very good month to buy stocks. And so in today's video, let's talk a little bit about all of the red that you're seeing right now on the screen. Let's touch on 4 specific companies that are maybe worth putting on your watch list or maybe buy list. I'll also talk about what I plan on buying in the month of September, not tomorrow, maybe next week, maybe in 2 weeks from now, depending on the opportunities. And of course, as always, I'm not here to waste your time. So here are the 4 companies. I do hope you keep watching, and if not, at least leave me a like and a comment. I also would love to thank every new member of the channel, especially the newest one and the existing ones that have decided to upgrade. I really appreciate you all. All right, so first up, a Bloody Tuesday. As you can see right here, it's red across the board. Plenty of familiar names, popular names, names that you own, that I own, are red today. But is it red enough? Right? Is it red enough for me to suddenly jump in? No, probably not. Probably not. It's something I also said during the live streams. Okay, Nvidia is down another 3.6, Google is down 2.5, AMD 1.8 at the time of making this video. When this goes live, things can be green or it can be even more red. But it's not like we've been going down 10% every single day for the last week or so. This is something that has happened at the end of March, beginning of April, well, back in January, right? Or January, February, when we had that DeepSeek crash, things went down in a matter of a couple of days by 20%, 30%. And Nebius was down 44% in less than a week, right? Actually in a matter of 2 days or so. So it's not like we're getting something like that. But then again, we just started the month of September. And in case you've missed the, countless times where I showed you this on the stream or in other videos, so this is basically what has happened with the S&P 500 on average since 1928. You can clearly see that September is not a good month, right? On average, it's down 1.2%. February and May are the other 2 months where the market, on average, the S&P was down a little bit, which is quite interesting because there is that saying, right? Sell in May and go away. So what's with September, right? Well, why doesn't September get a nice quote? Sell in September and then remember to buy again in December? That's not bad, right? Not bad at all. I came up with that on the spot. Anyways, there are a couple of theories here. I'm not going to go over all of them again and again. Some of them make sense: portfolio rebalancing, tax loss selling. Okay, but then again, September, October, November, December, you're probably going to hear a lot about the tax loss harvesting part, behavioral biases, investor psychology, economic factor and business cycles. I think this one, especially in 2025, with potential rate cuts, with still tariff deals going on, I think this could definitely impact the month of September. Back to school effect, I don't buy into this. And the last one, yes, the self-fulfilling prophecy, right? So if everyone thinks that, oh, September is going to be a bad month, maybe we're all going to front run it. Maybe we're all going to say, you know what? Maybe let me just take some profit. Let me start selling a couple of shares here and there. And if everybody starts selling, even if it's a little bit, a lot of little bits, become quite big of a sell-off. And so I do think that the self-fulfilling prophecy is maybe the best theory here out of them all. But then again, these are opportunities. These are opportunities to buy more shares of great companies. With that said, let's start here with company number 1. Never touched on this company on the channel fully, and that's Rubrik. Rubrik is a new company that went public back in May. Before that, if you enjoy all these type of videos, of course, hit all the buttons, especially the notification bell. Only 10% of you have the notification turned on. That's why you're always missing the live streams. Unacceptable. So hit that button. Thank you very much. And if you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And a special thanks to fiscal.ai, which is this platform right here, stock research platform, for sponsoring this video. They've been a partner for a while. You've seen this platform in most of my videos. There's a link down in the description and in the pinned comment to get 15% off. And new members can try it out for free, Fiscal Pro, for 2 weeks. And so I'll explain throughout the video what you can do with the platform. But here, first up, Rubrik. provides data security, cybersecurity company, provides data security solutions to individuals and businesses worldwide. The company offers enterprise data protection, unstructured data protection, cloud data protection, and SaaS data protection solutions, etc., etc. It's a company worth $17.3 billion. It is not profitable yet. It is growing and expected to grow actually a bit faster the next 2 years compounded than in the last 3 years compounded growth rate. Average analyst price target sits at $112.5, whereas right now we're sitting at $86.50. This is a company that will report its quarterly figures, I do believe, next week. So if you really want to open a position in this company, you can look at their previous filings, which again is available here on the platform. If you don't want to read all of it, you can just click on AI summary and it will give you the summary of the whole transcript right here. So subscription ARR was $1.18 billion, up 38% year over year. Net new subscription ARR, $89 million in Q1. Subscription net retention rate remains strong above 120%. As for guidance, for the second quarter of fiscal 26, which is the one they report next week, they expect revenue to grow approximately 37 to 38% year over year. And so, Rubrik sits here in the middle. Comprehensive cyber resilience across data and identity. On the right, you have a lot of other cybersecurity names: Palo Alto, Zscaler, CrowdStrike, Okta, Mandiant. On the left here, you've got the enterprises on-prem, the cloud players, the SaaS players, unstructured data, and then here, identity. So Rubrik acts as a secure smart vault for companies' data. Its job is to automatically and continuously back up all of a company's information, but with a critical focus on making those backups unbreakable and highly secure against cyber attacks like ransomware. This allows a company to recover its data quickly and easily without paying a ransom, even after a severe attack. So they put themselves here in the resilience category. Maybe let me move myself right here. In the resilience category, data and identity, you have Rubrik. In the prevention category, you have network players like Palo Alto, cloud players like Zscaler, and endpoint players like CrowdStrike. These were the results for the last quarter, which of course next week you're going to get updated numbers, but this is point of reference for those that have never heard of Rubrik. This is basically it. And as you can see, subscription ARR cohort analysis, they are growing very fast, especially the newer cohorts. Customers with $100,000 or more in subscription ARR is also increasing quite nicely each and every fiscal year. And as for guidance for Q2 and fiscal year 2026, it's going to be interesting to see if for fiscal year 2026 something is revised on the upside, whether it's subscription ARR, total revenue, contribution margin, remains to be seen next week. They also gave us additional information for fiscal 26, which is always useful. I like to get more information from each and every company. So they did say with regards to subscription ARR contribution margin, they expect subscription contribution margins to be lower in Q2 than Q1 based on seasonality, but they do expect Q3 to be the seasonally lowest before moving higher in Q4. So don't be surprised by that. Free cash flow, they do expect Q2 free cash flow to be roughly break even, Q3 to be higher than Q2, and Q4 to be higher than Q3. That's good to know. Last thing here, gross profit margin has been increasing over the last couple of years. Free cash flow margin has been doing the same thing, went from negative territory to now positive territory, 10.6% on an annual basis. Moving on to stock number 2, maybe a bit less sexy than the usual name that we cover, but still very, very strong company, as I've shown you in Monday's video or Sunday's video. One of the videos where I talk about pricing power, FICO, Fair Isaac Corporation, currently experiencing a 37.7% drawdown. It's a company worth $36.5 billion. High margins here, gross, net, free cash flow margin. Very, very strong company that is experiencing a rather large drawdown, which also means that it is less expensive today than it was before. This is a company that has a very high trading PE, close to 60 times, forward PE, 45.3 times. You might say, oh, it's very high as well. Yes, it's higher, let's say, than the usual number that we're used to seeing, but not every company has this pricing power. Not every company has these types of margins. And this is a company that is still expected to grow quite rapidly, top and bottom lines. And if we look at the average PE over the last 10 years, that sits at 50.3 times. We're now closer to 60 times. We're, of course, much, much higher before. But yeah, just because we're higher before does not mean that we should be going as high. But just to show you that on average in the last 10 years, PE, trading PE, sat at 50 times. As for the business, by the way, this represents 88% margin. This is the total scores revenue and the scores operating income. That's 88% margin. Incredible business, okay? Incredible business across the board. I do have here 2 comments, and this is 2 comments shared by Emir. I will share something else with regards to Emir in a second. But when talking about Vantage, right? Because everybody's been talking, oh, FICO's business is going to be under pressure, etc., etc. Well, they said the following thing. We don't see any signs of it whatsoever. I mean, Vantage has touted big volume numbers for quite a long time, years and years and years. I think the big question is who's paying for it? Because the answer is hardly anyone. The Vantage score gets sent along for free when the lender inquires at a bureau for a credit line and a FICO score. They get the credit file and a FICO score, and they get a Vantage score that they didn't ask for. And so that's the genesis of the big volume numbers that Vantage reports. We're not seeing any share loss at all. And if you want to learn more about the FICO business, I highly suggest to check out Emir's Substack, Type F Capital, Substack, and YouTube channel. Both of them will be linked down in the description below. Not getting paid for this or anything, just a good friend with high quality content and research. FICO's margins are, of course, expanding over the last 10 years. We went from 67.7% gross profit margin to now 81.7%. Free cash flow margin went from 14.5% to now 40.2%. This is again on an annual basis. If you look at total annual recurring revenue, that has also increased throughout the year, as we're talking here also about more software type of revenue. Basic earnings per share. I mean, this has grown at a compound annual growth rate of 25.8% over the past 10 years. Looking at free cash flow, same thing here. The past 10 years, free cash flow has grown at a compound annual growth rate of 20%, still expected to grow around 20% for the upcoming fiscal years. And lastly, the shareholder yield for FICO, of course, spiked as the stock price went down. But guess what? The business is still an excellent business. And now you're getting here a shareholder yield of 6%. Now, the next company we're going to touch on is, of course, maybe a hated company, but it has a higher shareholder yield than FICO. And that company, of course, is called PayPal. The one and the only PayPal is now valued at $67 billion. This is a company that I do believe, as long as the stock remains so low, it just allows them to buy back an insane amount of shares, right? Currently, market cap under $70 billion. If they're going to buy back between $6 to $7 billion worth of shares this year, that's quite a big return for future shareholders or current shareholders, but in the future. It's insane. It's insane. This is a company that is extremely cheap, that, is not dying as the market implies it is. It is a company that is growing, right? Okay, might not be growing as fast as before, although I do think that we're going to see an acceleration, small acceleration though, in Q3 and especially in Q4. And then you're lapping those very, very easy year-over-year comparisons in 2026, which of course will help the sentiment around the stock. If we're looking at PayPal's trailing PE, sits at 14.7 times. Looking at the 10-year average, that was 43.3 times. Of course, we have here a big negative impact from the pandemic period where everything was inflated. But even if you remove that, it is, of course, the average will be much, much higher than, let's call it, the 15 times that we're at right now. Here, if we're looking at the shareholder yield, currently sits at 11.1%. It's insane. Okay, it is insane. That's what I'm keep saying. PayPal is one of the best risk-reward plays at the moment. You might say, yeah, but opportunity risk. I say opportunity risk is when you're looking back and say, oh, I should have bought this and that, right? Because you don't know. We didn't know that the market is still going to be blind on PayPal, right? Just like we didn't know that the market was blind on Google before. Just like we didn't know that maybe a company like Robinhood or a Palantir or whatnot was going to go up so fast. We knew there was value there. We just didn't know that the market would react so aggressively on the upside in that case. And so in PayPal's case, I still view it as extremely undervalued. And yes, I do think that it will crush the market from here on out. And for those that are not familiar, yes, PayPal, there are still people that use the PayPal platform. Actually, there are more active accounts today than there were ever before. Well, today, that was the last time they reported their quarterly figures, right? More today than even at the peak. So that's good. Second of all, operating margin. Operating margin is at all-time highs. Then if you look at transaction revenue and OVAS as well, that has been doing quite well for them, has been increasing. This could be another $1 billion revenue per quarter for them eventually. As for transaction revenue, that is of course still the majority of the revenue. Number of payment transactions, that has been trending down as of course Braintree has been slower than before. It wasn't a growth at all cost anymore. It was more on the profitable side as well. But I do think that in Q3, Q4, you're going to see that change. As for transaction margin dollars, that has, of course, as Alex Chris has said, that has been increasing more recently. And of course, total shares outstanding, especially since Alex Chris came in, and especially since the stock came down and free cash flow keeps on increasing, while the share buybacks have actually accelerated, and so share outstanding are coming down at a rapid pace. Moving on to the last company, and that's Hims and Hers. Hims and Hers sits at $9.57 billion in market cap, back to $41, so close to that $40 line, which is basically, I'll show you later, basically at the 200-day moving average. This is a company that, of course, has been growing extremely rapidly over the last 3 years, still expected to grow rapidly over the next 2 years compounded. Looking at the number of subscribers, that did increase 30.8% year over year to 2.4 million. That did barely increase quarter over quarter. Online revenue did also increase 75% year over year, but as you can see, the year over year comparisons are, let's say, easy, although it's still year over year growth on top of that 52.5%, but it is, of course, easier than before. That's why you are going to see the year over year growth rates here come down a little bit. Free cash flow is expected to grow 59.5% in fiscal 26, and then another 39.7% in fiscal 2027. If we're looking at the other results for the quarter, again, still pretty good. They are also expanding. They've acquired a new company. They are trying to expand as much as possible across the globe. They believe they have the ability to help over 100 million consumers across the specialties and regions they serve. This is the active ones and the upcoming ones as well. There are some areas where there is no active or coming up at the moment. 100 million is, of course, a big serviceable addressable market for them. It's not the total addressable market, in my opinion. But with Hims, as I've said before, time and time again, this is not a company that you buy just for the compounded GLP-1 drugs or whatnot. No, it's a company you buy because of the platform that it provides. It's all about the Hims and Hers platform. It's not just about one specific product that they offer. Then they are still reaffirming that 2030 financial target, at least $6.5 billion of revenue and at least $1.3 billion of adjusted EBITDA. And so if we're looking at the stock right now on a technical basis, $41.20, just under the 200-day moving average. But as you can see, the last couple of times it either touched the 200-day moving average or just went under it. We have seen the stock recover quite rapidly. So if you were looking for an opportunity or entry point, I think that could be the one. And lastly, what am I looking at right now? Well, I'm looking at deals across the board, whether it's going to be Nebius, whether it's going to be Iron. I see Iron is actually up today 8%. At one point, it was, I think, down. Then it recovered to up 11%. Iron is a company that I own, speculative portfolio, but I do want to increase my position in that. We'll see. I will offer, of course, average up. I have no issues with that. Nebius is another company that I would love to buy more shares if we can get in the 50s. Even if it's high 50s, I don't care. I'll probably add a little bit more there. Duolingo, yes, $260, if we ever get there, might be another good opportunity to buy a little bit more shares. I'm looking for deals. I'm not looking for, oh, stock is down 4% from its all-time highs. It's a screaming buy. No, not at all. If next week, the next 2 weeks or so, I will see that these names are suddenly down 15, 20, 25% or so, but it can be a very, very slow bleed, then that becomes a lot more interesting, right? An AMD, if that ever goes back into the 140s, maybe low 150s, I think that's going to be a very, very good opportunity for me to add even more shares. And by the way, all of these stocks that I'm talking about right now, I am averaging up. I have no issues with that. I just want more shares. And so if I can get more shares at a better price, then that's great. I know I cannot time the market. Maybe I will never have the opportunity. Okay, fine by me. We also have potential rate cuts coming up, especially one rate cut in September. We'll see what happens, but these are the stocks that I have on my radar. Probably at number one is still Nebius. This is still a company that I do want to own more shares of. I did open a position last week in CoreWeave. It went up quite a lot, and now it's actually, today it's down 11.7%. So maybe CoreWeave might be the number one or number two, just to add a little bit more to that position and then be done with it and focus on all the rest. Oscar is definitely on the list here as well. So that's about it for me in this video. Yes, if September does become a very bad month, well, it will become a very good month to start buying more stocks. That's about it for me in this video. Do check out fiscal.ai. Link is down in the description and in the pinned comment. And do let me know what you plan on buying in the month of September. We'll see each other in the next one. Bye-bye.